Hello. I wanted to take a moment to share with you the rationale behind the portfolio changes that occurred in the models on September 21st. I'm using this format. Hopefully, you enjoy the presentation, but it also allows you to pause, to replay any areas that you would like to hear again. So we've seen the headlines. Housing markets are facing a painful reset. What's going on in China, bond bear market, et cetera. And we're going to continue to see these as companies reduce plans to hire or flat out lay off workers, given the fact that we're heading into a slowdown and eventually what I believe is a recession. Um, a statistic to keep in mind, and I'm sure you've heard this from me before, but it takes roughly 9 months for interest rate changes by the Federal Reserve to impact the economy. I'm not saying the stock market, but the economy. And so our first rate hike was in March. So again, expecting the full brunt of that to occur in December. And as these hikes roll forward, April, May, et cetera, then that just pushes out 9 months, January, February, March, et cetera. There are no plans for the Federal Reserve to reduce interest rates at this time, and it could be the end of 2023 or potentially even 2024 when we see that happening. So, starting out, initially, we want to talk about global economic conditions. This is a chart of the major countries, and it's ranked by their inflation rate. And in this case, Spain, United Kingdom, the Eurozone are slightly above the United States. And it reminds us that the economic conditions that we're experiencing in the US are occurring globally. We are seeing real GDP decline, we're seeing interest rates move higher, and unemployment undoubtedly will move higher as well as central banks seek to tame the inflation rate. I use a number of companies to help demonstrate concepts that are occurring in both the economics and also in the markets. Um, I saw this, and I apologize for it being blurry, but it's set up. There are 12 indicators on the left that show us kind of the data points that Helios aggregates together to generate this chart, as well as this dotted line, which clearly was at a high point in September. Consumer sentiment at the top, you can see, is in a bad position. It's at a low that we haven't seen in some time. And that's simply, will consumers continue to spend like they've been spending? Remember, the consumer is roughly 65% of our annual gross domestic product, or GDP. So it's an important consideration as to the growth of our economy. Um, we do see some production increases, we do see some sales. The issue is whether or not it's nominal or it's in real terms. What do the economists expect? So Helios, again, is a quant-based investment advisory firm. And what this chart shared is the fact that the median estimates on the go forward are low. 1.5, excuse me, 1.4, 1.2, 0.9, as compared to where we were post the fall in the pandemic. Again, stimulus money. But if we take this out and we go back to 2019, you can see how our growth rates are going to be lower. And the question that I pose in a later slide is, if you had an asset allocation set for this economy, would it be the same for this economy? And of course, my answer to you is no. Now, there's been a lot of talk about an inverted yield curve, and so I wanted to share some information about that. The dashed line is from the start of the year, 12/31/22. And we have seen interest rates move higher, but also interest rates on the shorter end move higher. And that portends a recession. And whether or not, or a slowdown, and whether or not it's the 2 to 10 year that's inverted, in addition to the 3 the 3 month to 10 year, right, is remains, of a debate as to which one will kind of portend the future. The 3 month to 10 year is currently at a 0.20, the difference. So we are close, and whether or not that's a signal, but certainly the yield curve tells us that it's far better to invest short than long because of the uncertainty of the economy long term. Another interesting data point that I saw today, um, we're seeing home inventories rise, and that may also give us another window into the depth of a recession. As you know, mortgage rates are above 6%, which really squeezes the pool of potential home buyers and their ability to buy the more expensive homes that have been driven up because of inflation. Just a bit on recession history. Recessions, of course, are painful. Nobody likes to lose their job or lose money in the equity markets, but we want to be reminded that the expansions, the growth in the economy, and have given us much more than the recessions have taken away. The key, and we'll discuss this later, the key is to manage your both asset allocation and sector allocation to minimize the recession decline so that you have more capital at the expansion phase of the business cycle. All right, inflation. Simple chart, housing and food make up about 45% of the CPI number. We recognize we are seeing food inflation, and that's a number of reasons why that's occurring, but unlikely to end anytime soon. And housing, we're in the same boat. We have priced out of houses because of the inflation rate and the interest rate, and we're seeing a lack of apartments, of affordable housing. And that's going to continue to roll forward and is tough for the US to get a handle on, as food is a global issue. So Moody's is a great outlet for information, along with Morning Consult. And in this chart, it shows us that the spending has changed by the consumer from last August to this August. So last August, consumers were spending on restaurants and gas and hotels. And because these have gone up so much because of inflation, they have to reallocate the dollars that they have to spend. And unfortunately, because healthcare, education have gone up, we're having to spend less on the basic necessities. And again, a trend that will continue, although we expect to moderate. There's been a lot of talk about bonds and bond returns. And we've seen this year a historic bear market in bonds. So what I want to point out in this chart is, and this is from the year to date of, from starting from January, that the two indexes, the Bloomberg US Aggregate and the Bloomberg US Credit, which are medium and long-term duration bond funds, which are owned by many investors, have seen pretty significant declines year to date, 12.5 and 15.3. And in December, when the Fed made an announcement that then in March they were going to raise rates and begin quantitative tightening, it's a watershed event, in my opinion. And it was at that time that I took my longer term bonds and shifted those to short term, low duration, ultra short, floating rate type bond ETFs. Now, as you can see, I'm not getting much cash flow return, although GSY is now at a 3.15 yield. But what I was most concerned about was not my yield at the time, because these were paying a higher yield, was that the potential for loss as interest rates moved higher. The math tells us that if we see a 1% increase in interest rates, we'll see medium and long-term bonds decline anywhere from 20 to 25%. So rather than take the risk of the higher credit but losing a principal, I shortened it up in December and have enjoyed minimal losses as compared to the longer term bonds. This is a shift that most financial advisors should have done and certainly been aware of. Now, we're going to become in a period in which the trade-off between owning stocks and owning bonds is getting much more difficult to choose from. And so as we look at this chart, we can see that the top chart is the target on the federal funds rate. And yesterday it was just increased, so it's at 3.25. The expectation by the Federal Reserve is that it will be at 4.4% by the end of the year. So additional increases by the Fed to go from 3.25 to 4.4 over the coming months. What that does to bond prices is it reduces the price of the bonds. This middle chart is an ETF. It's an iShares iBoxx High Yield Corporate Bond ETF. And it shows that over the course of this year, this has declined in value by 14.25%. At the same time, as prices go down on bonds, the yield moves higher. So it's pushed the yield to over 5%. Now, at some point, this will reach a ceiling. Rates will continue, will stop moving higher. This will stop moving lower, and it will make sense to own some bonds as we get to a higher coupon or a lower price. That could simply easily occur January or December of this year, in my estimation. And that's when we will shift from the short-term bonds to a longer-term bond with a higher dividend yield. Now, on the other side, once the Fed has stabilized the economy, reduced inflation, they will lower interest rates back down to maybe the 3 or 3.25 range. And when that happens and the rates decline, the price will begin to increase. And as that price increases, we'll get a capital appreciation in addition to the coupon. More to come on that one. As I mentioned in an earlier slide with respect to various economies, in 2019, we saw much higher growth rates than we will in 2023 and 2024. And your investment allocation should be different. So this is the drop in the S&P 500 due to the pandemic and the shutdown of the US by the government. And this is, the purple line is GDP. So yes, when we hit a bottom in the S&P, we do not want to sell and move to cash. We want to, over the course of the next period of time, understand where the economy is going and then make shifts in the portfolio, both from an allocation perspective and a sector perspective, to better match the upcoming economy. It took a couple of months for this to sort out, but post that, the sectors that benefited were energy, consumer discretion, and technology, because from clearly the work from home factor. Same goes up here, same goes out here. As we stand on the edge of continued higher interest rates, is your portfolio properly adjusted? The change in the models that I made yesterday reflects a slowing economy, potentially tipping into recession, reduced investment in both emerging markets and international markets, and a change in the sectors to better take advantage of a slowdown. Here's our traditional business cycle. We are without a doubt in a late cycle headed towards that recession. I think at this point, the soft landing that economists talk about is probably off the table, given the fact that Chairman Powell came out and put his foot down and said we're going to keep raising rates until we bring inflation down. So undoubtedly, we're heading down to this area, and we could sit down here for a year, 10 months from now, before we again see a decline in rates and then a pickup in economic growth. As I mentioned previously, from a textbook point of view, as you head into a recession, you want to own consistent earning sectors, consumer staples, utilities, healthcare, and maybe some consumer discretionary, but not at this time. These are steady. Everybody needs electricity. People continue to buy, in my example, Q-tips and shampoo. And so whether or not yesterday was the best day to make that shift, what I always want to be is a little early, because not only do we want to own these companies, and this blue and the green I'll share in a minute, but we also want to get there before everybody else gets there. We saw earlier this year utilities move and got expensive on a PE rate on a PE basis, but the fact that we're going to continue to see these rate hikes pushes me to own more of the defensive stocks, and so began to add more to utilities, energy, and a higher allocation to consumer staples. The geometric average, the blue bar, is simply the amount of relative performance above the benchmark, i.e., the S&P 500, that these sectors will or have provided from 1962 to 2020. What's also interesting is recognizing when stocks deliver returns throughout the business cycle. So this chart reads stocks, bonds, and cash, early cycle, mid-cycle, late cycle, and recession. So clearly we recognize that stocks fall during a recession, leading into and during a recession. And so, we aren't looking here to capitalize and own a lot of stocks because we think that they're going to move higher. No, we're in a defensive position. We want to minimize our downside so that we have more capital as our next business cycle comes around. Same goes for bonds, right? We want to be able to, at that point when bonds have reached their worst place and price, that's when we want to buy, and that's typically during the recession as interest rates have, rates go up, prices go down. And so again, we want to preserve capital and be ready to capture that higher yield as the recession continues. We got many risks that are present. Here's a handful. Who knows where we go with these, but clearly we're going to continue to see a decline in the economic activity in the United States and in the world for the foreseeable future, and we want to be prepared, and so that's why I made the changes. Please let me know if you have any questions, and if this is something that you might feel a friend or relative might appreciate watching, please share with them. Thank you.